What if I told you that right now, some of the absolute smartest hardware engineers in the world are aggressively betting their time, their supply chains, and their careers against Wall Street's favorite technology stocks?
Yeah, it's honestly a fascinating contrast. You don't usually see that level of disconnect.
Right. So, welcome to the deep dive. Today we're opening up a really controversial set of personal notes from a contrarian investor who realized, well, a pretty fundamental truth about the deep tech sector.
And that truth is that the people actually writing the code and designing the architecture are actively fleeing the very companies that are being championed by the people writing the checks.
Exactly. So our mission today, for you listening, is to look at a landscape of semiconductor and photonics investing that has it's completely detached from physical reality at this point.
Oh, entirely. We're essentially looking at a masterclass in how to dismantle mainstream financial hype.
Right, reevaluating what makes a tech company actually valuable. Because we're going to spot the mechanics of a business that Wall Street analysts are just completely blind to.
The contrast in these notes is really striking. I mean, this investor isn't just handing us a list of alternate stock tickers to buy.
Yeah, it's way deeper than that.
Exactly. They're presenting a fundamentally different framework for evaluating risk. We are constantly fed this narrative that financial analysts, with their supercomputers and these incredibly complex spreadsheet models, have this perfect objective view of the market.
Right, like they can see the matrix or something.
But financial models are built on assumptions. If you don't understand the underlying physics of the technology or the raw mechanics of the supply chain, your financial model is just, well, a very expensive piece of fiction.
A very expensive piece of fiction. I love that. And if you are managing your own portfolio, or even if you're just fascinated by the hidden gears that run the global tech economy, this deep dive is going to permanently alter how you consume expert analyst reports.
It really will.
We're going to look at the specific mechanical reasons why market winners win and losers lose. And to do that, we kind of have to start our journey in the graveyard.
Always a good place to start.
Yeah. We need to look at a specific loss documented in these notes to really understand the fatal allure of what they call the choke point.
Right, the choke point. It is perhaps the most heavily weaponized buzzword in modern investing.
Oh, for sure.
Analysts use it to practically hypnotize investors. The theory is that, a company controls a singular, unavoidable bottleneck in a supply chain.
Like you have to go through them.
Exactly. If an entire industry needs to build a specific device, they are forced to buy this one component from this one company. And so the market prices that company as an inescapable monopoly.
But the notes highlight a pretty brutal reality check on this whole concept. The author points to a specific stock ticker symbol, HMX.
HIMX.
It's down a massive 31.54%.
Yeah.
And the author explicitly categorizes it in the notes as a meme stock.
Which tells you a lot right there.
Right.
Right.
But the real takeaway isn't just that the stock collapsed. It's the specific reason why the author actively avoided taking a long position in it while, everyone else was just buying the hype.
They saw the mechanical flaw in the choke point argument?
Exactly. I mean, okay, let's unpack this. A choke point sounds brilliant on paper. It's like owning the only toll booth on a vital mountain pass.
Right.
Every single data packet or hardware manufacturer has to stop and pay your toll.
Right. That's the financial perspective.
But what happens when you look at that from an engineering perspective?
The engineering perspective is ruthless. I mean, financial analysts just assume that if a choke point exists, the industry will line up and pay the toll forever.
Right. Just blindly pay up.
But engineers are practically allergic to bottlenecks. If a component supplier starts acting like a monopoly, raising prices or restricting supply, the chip designers don't just sit there and take it.
No, they actively innovate to bypass the bottleneck.
Exactly. They might shift the computational heavy lifting away from that specific hardware component and offload it into the software layer. Or they might completely redesign the motherboard architecture, right? Like utilizing 3 cheaper, generic, universally available chips running in parallel
to do the exact same job as the one expensive proprietary chip?
Precisely. Going back to your analogy, they will literally dynamite a new tunnel through the mountain just to avoid your toll booth.
They engineer the choke point out of existence. Your inescapable monopoly just vanishes because the architecture evolves around you.
It happens all the time.
And the notes reveal an even more insidious trap here. Let's assume the component can't be designed out. Let's assume your toll booth stays put and no one has dynamite. The author points out that this still doesn't guarantee success if the choke point isn't material enough to translate into actual revenue.
Which is the ultimate analytical failure.
Right.
I mean, a company might have a total unassailable monopoly on a highly specific microcomponent, but if that component only costs, like, 4 cents and the total global demand for it is negligible.
You own a monopoly on a puddle.
Exactly. You own a puddle. The notes actually use another stock, AXTI, as a comparative warning for this exact scenario. You can have a technical moat, but if it doesn't translate into a material revenue stream, it is structurally useless to an investor.
Structurally useless. So the author looked at HIMX, looked past the buzzword, saw the lack of material revenue translation, and simply walked away.
They sidestepped a 31% wealth-destroying drop.
Because they asked the mechanical question instead of buying the financial narrative?
Yeah.
But here is where the notes introduce a fascinating and I'd say highly debatable twist. After dodging that bullet on HIMX, the author adds a massive caveat.
The macro caveat.
Right. They note that the recent drop across the board, which included HIMX, was accelerated by macro. Broad macroeconomic forces pushed everything down.
The macro blanket covers a multitude of sins.
Okay, here's where it gets really interesting, but also a bit confusing for me. I have to push back hard on the author's logic here.
Go for it.
If macro factors, inflation data, interest rate hikes, global liquidity pulling back, if that's dragging absolutely everything in the sector down simultaneously, how do you even know if your specific thesis was right or wrong?
It's a fair question.
Isn't blaming macro just a convenient excuse for investors when their picks start losing money? It feels like the ultimate cop-out. It's the equivalent of saying, my brilliant prediction about this company was absolutely flawless, but the global economy ruined it.
Right. I was right. The market was wrong.
Exactly. Isn't that just a convenient shield for poor performance?
Look, that skepticism is entirely justified. I'd say the majority of retail investors use macro conditions as a psychological defense mechanism, right, to avoid admitting they just bought a bad company.
Yeah.
But the author is demanding a much higher level of intellectual rigor here. They explicitly state that a macro-accelerated drop doesn't necessarily mean an individual stock thesis was inherently wrong.
Okay.
They point to their thesis on another stock, SIV as an example. The challenge they're throwing at you is learning how to separate a structural failure from a temporary environmental hostility.
But how do you practically achieve that separation when your screen is just a sea of red? Everything is down.
You have to look at the integrity of the underlying mechanics. Let's stick with a boat analogy here.
Okay, I like boats.
If a massive storm rolls in and the tide rushes out, every single boat in the harbor is going to drop in elevation.
Sure.
The macro environment dictates that. But the vital question is what happens to the boat itself. With a company like HIMX, the author is arguing that the boat already had structural holes in the hull.
Oh.
The engineered choke point was a flaw, the lack of revenue was a flaw, the macro storm simply accelerated a sinking that was fundamentally justified anyway.
So the structural integrity was compromised before the storm even hit.
Precisely.
Mm-hmm.
Now look at a company where the core thesis remains intact, like the author suggests with IVE. The macro storm hits, the stock price drops, but the balance sheet is still expanding.
Right.
Customer retention remains ironclad. The supply chain is still demanding their product. The fundamental mechanics of the business are flawless. They're simply operating in a depressed valuation environment.
So the author is warning you not to abandon a structurally sound thesis just because the broader market is having a panic attack.
Exactly. Being a great long position is incredibly multifaceted. You have to differentiate between a broken company and just a bad tape.
A bad tape, right. Well, if the macro environment acts as a blanket that hides the underlying truth of these companies, we need to transition to a sector where the truth is completely obscured by Wall Street hype.
Oh, here we go.
The notes move aggressively into the photonics sector. And the valuation disconnect detailed here it's nothing short of breathtaking.
It really is. And to appreciate the scale of the disconnect the author is calling out, we have to establish why photonics is currently the center of gravity for tech hype.
Right, let's lay that groundwork.
So, the traditional method of moving data inside data centers relies on electrons traveling through copper wires.
Good old copper.
Right, but copper has physical limits. When you push massive amounts of data, like the data required for modern artificial intelligence, copper generates an immense amount of heat, and it suffers from severe latency. The industry is hitting a physical wall.
Literally burning up.
Yeah. Photonics solves this by using photons light to transmit data through fiber optic cables. It's exponentially faster, carries vastly more bandwidth, And, crucially, it runs cool.
So it is the absolute required foundation for the next decade of computational scaling.
Without a doubt.
And because it's so vital, the financial hype machine has just gone into overdrive. The notes explicitly call out how the author heavily disagreed with a large number of, quote, photonics picks made by mainstream financial analysts.
Just throwing darts.
Basically, they provide a glaring specific example in the notes. Analysts were calling for a stock, PTOT, to be valued at 7 times the valuation of CES.
A 7x premium.
Which the author points out is mechanically absurd, because Sekka Dave is actually the laser supplier. So analysts are hyping up POET to be worth 7x more than SIVE. That's like valuing a trendy new coffee shop 7 times higher than the actual farm that holds a monopoly on the exact coffee beans they need to exist.
That's a great analogy.
Why are analysts missing the underlying supplier? I mean, valuing the aerodynamic carbon fiber chassis of a hypercar 7 times higher than the proprietary engine block that actually propels it? The laser is the engine of photonics.
It is the literal light source that makes the entire concept function.
So why is Wall Street modeling astronomical valuations for the chassis while completely ignoring the company that holds the monopoly on the engine?
Well, it reveals the fundamental flaw in how analysts build their models.
Which is?
Financial analysts are incredibly susceptible to consumer-facing narratives. They fall in love with the company that has the slickest presentation, right? The one showing how their specific application is going to revolutionize the end-user experience.
So they buy the pitch deck.
Basically, they build their spreadsheets based on highly optimistic projections of market share capture. But the author is looking at the raw supply chain. The chassis is useless without the engine pushing the data. And the most damning piece of evidence in the notes is the observation regarding the actual chip designers.
This is the paradox we opened with.
Yes. The engineers who are physically designing the next generation of server racks, the people who actually understand the thermodynamic and optical physics required to make this work, they are actively going the opposite direction of the financial analysts' picks.
They are ignoring Wall Street's favorite darlings.
Completely ignoring them.
Think about the gravity of that for a second. If you're an investor blindly following analyst price targets, you are buying into a financial fiction. Analysts are projecting massive adoption rates for these hyped companies, but the actual architects of the technology, the people who dictate what components are actually purchased and integrated into the global supply chain, they're refusing to use them.
Yeah, and if the engineers aren't buying the hardware, the analyst's financial model is dead on arrival.
The spreadsheet means nothing if the factory floor rejects the product.
Exactly. And that's why the author is perfectly comfortable standing alone against a wall of consensus buy ratings. They're anchored to the engineering reality. They know the financial analysts are detached from the supply chain mechanics.
They're looking at the raw physics of this situation.
Right, and realizing that the consensus picks are built on sand.
Okay, so we've spent a significant amount of time unpacking what this contrarian investor actively avoids. They avoid the trap of fragile, revenue-less choke points. They refuse to use macro conditions as a blanket excuse for a broken thesis. And they completely reject bloated analyst valuations that defy supply chain logic. So the ultimate question remains, what actually earns their capital? Where do they deploy their money with high conviction?
Well, they seek out companies that possess the exact structural antidotes to the flaws we just discussed.
And then notes reveal a high conviction position in a stock called AAOI. And predictably, the analyst community is actively bearish on it. Wall Street hates it, while this investor considers it a cornerstone of their strategy. The author asserts the analysts are dead wrong because their spreadsheets are incapable of modeling 2 critical mechanics.
And those are?
A massive total addressable market, or TAM, paired with high optionality.
Okay, let's ground this in the hardware. The notes mention a material TAM increase based on projections for optical transceivers.
Right.
Now, an optical transceiver is essentially the translator box at the edge of a server. It takes the electrical signals generated by the computer chips, translates them into pulses of light, and shoots them down the fiber optic cables.
So it's the bridge.
Exactly. And as data centers scale up to handle advanced computational loads, like we talked about with AI, the demand for these transceivers isn't just growing, it is going vertical. The ceiling for this market, the total addressable market, is expanding at an unprecedented rate.
The pie isn't just getting bigger. The entire bakery is expanding. The notes highlight that AAOI has a demonstrable revenue ramp into this expanding TAM. They aren't just theoretically positioned to benefit. The mechanics of their sales are already accelerating to capture the demand.
They're already making the money.
Right. But it is the second factor, optionality, that truly breaks the analyst models. So what does this all mean for you and me? The author says analysts are bearish because they ignored optionality. Are analysts just lazy? Or is optionality legitimately too difficult to model on a spreadsheet?
It's that analysts struggle with optionality because a spreadsheet demands a linear, predictable input.
Ah,
A traditional financial model assumes company X will manufacture product Y, sell it at a 20% margin, and grow that specific product line by 5% annually.
nice and tidy.
Right. But true technological optionality is nonlinear. Let's step away from the tech for a second to visualize it. Imagine two companies. Company A has mastered the absolute perfect method for building one highly specific type of suspension bridge. They are the best in the world at it. Company B, however, owns the patents on a revolutionary new type of foundational concrete and high-tensile steel.
So company A is a choke point.
Yes. And if the global economy decides it no longer needs suspension bridges, Company A goes bankrupt immediately. Their skill set is completely rigid.
They don't.
Company B has optionality. If suspension bridges fall out of favor, they can pivot their materials to build skyscrapers or dams or fortified tunnels. They own the fundamental building blocks, which gives them multiple highly lucrative paths to success, regardless of how the end market shifts.
Wow, okay. Applying that back to the semiconductors, AAOI isn't just locked into one rigid product cycle.
Exactly.
Their engineering foundation allows them to pivot and adapt their transceivers and components to serve whatever specific need the massive expanding TAM demands next year or, 5 years from now.
That is the essence of their value. Wall Street analysts look at AAOI, realize they cannot neatly map out exactly which product will generate exact revenue in Q4 of next year due to this immense flexibility, and they label the stock as too uncertain.
They issue a bearish rating because the optionality breaks their linear models.
Right. But the author of these notes looks at that exact same uncertainty and sees extreme resilience.
Contrast that robust resilience with the HIMX strategy we analyzed at the start. I mean, HIMX was the suspension bridge builder. They had a fragile choke point that could easily be engineered around by resourceful chip designers, and it generated no material cash flow.
It was rigid and fundamentally weak.
Whereas AAOI has a clear, accelerating revenue ramp feeding into an exploding market, armed with the engineering flexibility to adapt to changing architectural demands.
That is a structural mechanic that drives relentless long-term value.
Entirely independent of whether a financial analyst can build a clean chart for it.
The author is highly pragmatic about this approach, too. The notes explicitly say, quote, "We'll see who's right or wrong in a year's time."
They know it's a waiting game.
Yeah, they are fully aware that macroeconomic tides will continue to cause turbulence. But their investment conviction is anchored to concrete reality, an expanding TAM, verifiable revenue growth, and deep engineering optionality.
Rather than the fragile, fleeting narratives that dominate the daily financial news cycle.
Exactly. It fundamentally rewires how you evaluate a technology company.
It really does. Let's pull all these threads together to see the complete picture this investor has painted for us. We began by tearing down the mythology of the inescapable choke point. We saw the mechanics of how a supposedly perfect monopoly can be actively designed out of existence by engineers who refuse to be bottlenecked.
Or how it can simply fail to capture any meaningful revenue in the real world.
Right. Owning the toll booth is meaningless if the engineers invent flying cars.
Exactly.
From there, we navigated the incredibly deceptive nature of macro market downturns. We learned that when the entire sector bleeds red, you must rigorously separate the performance of the underlying business mechanics from the panic of the broader economic tide.
You have to investigate whether the company's hull was breached or if the water level simply dropped.
A vital skill for maintaining conviction when the market turns hostile.
Absolutely.
We then exposed the severe disconnect between the spreadsheet models of Wall Street and the factory floor reality of photonics. We highlighted the absurdity of placing astronomical valuations on the flashy, consumer-facing chassis while completely ignoring the proprietary laser engines that power the entire system.
And we recognized the danger of investing in hardware that the actual architects of the technology are refusing to touch.
Refusing to touch. Finally, we arrived at the core strategy that earns this investor's true conviction: the power of the TAM antidote. True resilience isn't found in fragile bottlenecks. It is found in companies demonstrating a massive total addressable market, a tangible acceleration in revenue, and the engineering optionality to pivot and thrive no matter how the industry architecture evolves.
The overarching lesson codified in these notes is a brutal reality check for anyone allocating capital in the tech sector. As the author states with absolute clarity, not all lesser-known choke points make great longs.
If the technological advantage doesn't translate into undeniable material revenue, the narrative is nothing more than expensive noise.
It's just noise.
And cutting through that noise is exactly what we set out to do.
Hmm.
That brings our analysis of these notes to a close today. But before you step back out into the markets, I want to leave you with one final lingering thought to chew on.
Mm-hmm.
The author made a profound observation that the engineers physically designing our technological infrastructure are investing their resources in the exact opposite direction of where Wall Street consensus is pointing its money.
It's a massive red flag.
It is. The next time you open a financial app and look at an analyst's strong buy recommendation for a tech darling, ask yourself a very simple question. If the brilliant minds who are literally writing the code and forging the silicon of tomorrow are aggressively betting against the financial experts who are merely selling the stock, who is actually shaping the future of the market? The people building the architecture or the people building the spreadsheets?